Hi student, in this video I want to show you how to set and how to trade whatever currency you want. So in this example I will take the USD GP yen, which is a pair that I personally don't trade. I only trade the Euro USD, but anyway, let's take it and let's see how it is. So as you see here, we see the Japanese candlestick bars on this chart, okay? This is the chart we don't want to analyze. Why? Let me zoom out. As you see, I'm looking at the monthly chart, and what you see here is that even if you have bullish trends, like in this trade, in this case here, or bearish period, like in this moment here, you see that there's a lot of retracement, and even if when the market is trending down without retracement, there are months in which price went back. So little retracements like here, this one here. And so these are all, this kind of information are all period in which you don't know what to do, you don't know where the market is going, you don't know nothing about it, okay? So let me evidence all these periods in time, because I want to show you that using the right proper chart, as we studied in the course, the Eikinashi chart, all these little movements are reduced. It doesn't mean that you will not see them. Of course, this bigger retracement, it will be probably seeable, but you will filter a lot of noise, okay? Like in these months here, you will filter all these months here. So if we go, for example, we take the line chart, which is the one that we want to use in combination with the Eikinashi bar, and you see that in this scenario, for example, the little noise that we were looking at in the previous chart are nowhere here. There are no little noise. There are only the biggest noise. As you see, for example, this bar here, this candlestick here, and also all this one, you see, this one are not tracked on this kind of chart. This is why it is important to understand that the Eikinashi is used not because it is like the Holy Grail, but only because it is better to filter all the little noises, okay? And will leave you only with major retracement that can trigger another kind of trend, like as we see here, okay? So once we have identified what we should look at to analyze where the market is going, we will start trading. So as we already studied, the direction of the market is given by the color of the Eikinashi bar, which is this. For example, little blue for bullish trend and dark blue for bearish trend, okay? So once we have identified this, we want to start trading on the daily chart. And on the daily chart, for example, we will, for example, if we take this period starting from here, as we see, we are in a bullish trend, okay? So we want to trade bull. We want to trade on the long side. So we start from here, for example. We don't trade on this day only because the monthly chart is going up and this candlestick here is going down. So we don't want it. You don't want it. We will start trading from this candlestick here, okay? So we'll start trade and we set our entry bar, our entry point and our take profit, okay? That I will change color into yellow, khaki. Well, anyway, it's the same. So these are the pips we are going to win for every trade we will set, and we will continue following the trend, following days after days after days. And as you can see, there's a lot of little retracement here. If we go to the 4-hour chart, for example, but not only the 4-hour charts. As you see, all these little retracement, which are very simple also on the Aikainashi bar, not only on this, but if I look at the, for example, candlestick chart, Japanese candlestick chart, you see this day, this day, this day, this day, this day were against the major price movement. So I could have the idea to start trading like south, so start sell, and it would have been a mistake because the major trend is telling me the price is going up. So I don't want to use Japanese candlestick because or bar candlestick because they cover the Aikainashi bars. Okay, I only want to look at the line chart because it is telling me where the price is actually going. Because as you can remember, Aikainashi bars don't tell you where the price is because they're approximation. And as you see, the start of the bar starts at the middle of the body of the previous bar. As you see, the beginning are always in the middle of the previous bar, the body, okay? So the close is only the average of the 4 points, which are the current price. If we take this bar here, the beginning, the open, the highest, the lowest, and the close of the bar is the average of current price, open, lowest, highest point, and the close, so is the average of all these points here. Okay, so as we were looking here, so we use Aikainashi bars in order to filter all these rumor, and we start buying, and we start buying, and we start buying, and we start buying, and we make profit for all this distance. Okay, all this distance up to here. Okay, so that's a lot of pips. It's like, 334 pips, which you have to, of course, take out the cost of the spreads because you will set trade after trade after trade, but you will leave only 2 pips distance between the take profit of the previous trade and the entry point of the pending trade. And this is because you don't want to run the risk that the price will trigger your entry point, don't trigger the take profit if you set take profit and entry point at the same level, and then come back. Because as you have always to think about, price triggers before the entry point, then the take profit, because there is the spread. So you are basically always have to deal with 2 kind of prices, which are the ask price and the sell price. Okay, the ask price and the quote price. There are a lot of names of them, but at the end you have to understand that you have to cover the spreads. So when you set your take profit, make sure your pending order will be distance more than the difference, more than the spread on this chart. Okay, so for example, in this USD GP yen, depending on your broker, I have like 1.5 pips, so I will set at 2 pips distance. So you'll be making profit all this period like here, and the only trade you will have at the end of this price movement is up here, and it is this trade here, the entry point and his stop loss, and his take profit, because we don't want to use stop loss. So this will be closed, and you would have been making profit all this period here. Okay, I leave this line here. So then what happened? Then price comes back, and as we see in the chart, you don't want to trade on the sell side only because the monthly chart is not telling you that the price is going down. So you just don't trade all this period here. Okay, which are like 1, 2, 3, 4, 5, 6, 7, 8 days, around 2 weeks, if you consider that Sunday and Saturday and Sunday the market is closed. So for 2 weeks you don't trade. You just monitor every night your positions, where the market is going, but you don't set any trade. Once the market change color, like here, okay, in this bar here, you can enter back into the market. Why? Because the candlestick is up, is going up. The monthly chart is going up, and the distance between the lasting trade and the current price is higher than our oxygen region. And let me explain what is the oxygen region. You don't want to have multiple trades in the same price region that are lasting open. Why? Because you don't want to double your risk. Let's say, for example, that I'm trading 1 microlots per trade. If I, for example, the price come back here, and let's assume the price is up to here, okay? And I enter back with this trade here and another trade here, I'm currently duplicating my risk, and here I'm enhancing my risk per 3 because I have 3 trades in the same price region. Okay, so it's like having one bigger trade, one trade of 3 microlots, and I don't want the risk of trading more microlots, so I don't want to do it, and I have to leave like a distance between the lasting trade and the trade I'm going to put if the market comes back. So for me, it's at least 150 pips. In this way, or like 100 pips, like it is like around at this level. Okay, so at this level here, you have 113. Okay, so around here, at this level, you have the last trade you want to take. Around here it was, okay? So you are going to trade up to this level. And you are here, so you basically start trading from around here once the candle change color. So from here, you start trading up your take profit, and you make this profit up to here. Okay, and then what there's your lasting trade. You lost your trade, which is this one. So you have 2 remaining trades, 1 and 1. Price come back again, and you don't trade it. You don't trade it at all. You start trading back when the price market, when the color of the bar change in this level here, in this bar here, okay? You continue trading up, and you make this. No, you don't trade it. Why? Because you have to leave 100 pips. I mean, this is what I do. You could trade it as well. I don't do it because I don't want to have multiple risk, as I said. So you don't trade for 1, 2, 3, 4, 5, 6, 7 days. One week and a half, you don't trade. So up to the time the price come back, you close this trade here with a win. You close it, and you make profit up to this level here. So from here, when you had your last trade, to here. And this is the last trade you should take, because then there is the oxygen, let's call it, the safe zone. You don't want to trade, okay? It could be like 50 pips, 100, 150. It depends on you, I repeat. But this is what I do, at least 100. So you close it, and price comes back. You don't want to trade it, and then it comes back down. Of course, you have only one lasting trade. When price comes here, you can trade it as well. You can trade this zone as well. So what happened? You make this profit around from the closest. So yes, this profit around like this. And you have one lasting trade, which is this one here with your take profit. Now, this is the situation. This is the situation. So I made a mistake. So, yes, as we see, in this period of time, you've been profiting all these price movements, this price movement, this price movement, and this price movement. So in the same range of pips, in the same range of price zone, you have profiting all the price movement and then retracement without assuming more risk. And you have only two remaining trades now. Now, let me add the Ekinashi bars. Ekinashi. Okay, so the color are different, but it is the same. So the sell part is the bear bars are the red one and the bullish are the white one. Okay, so if I zoom out, you see that in this price zone, I've been profiting all this movement, this, and this. And if I look at the monthly chart, it is only a little part of a wider price zone. Okay, so I'm sure that if the price goes in south, I will only have two trades left. Okay, and I can deal with them pretty easily because I made a lot of profits up to all this period here of time. And you have just to remember that if you sum the pips that we made, for example, let me delete the Ekinashi. I don't want to see them anymore. Just to show you, if you sum all these pips here, this, and this, if price is currently here, and let's assume I think the price is going to change trend and to go south. So if I close this trade here, I'm only risking this trade here to lose. I'm only losing these pips. Okay, assuming that you are continue trading 1 microlots per pips. Okay, so I only lose these pips here, but I made more pips. So let's say price change direction, monthly bar change direction around here, and you have two trades left. If you are trading the same kind of microlots, you are basically losing. If you close this trade, the pips you have been making the previous week. If you start using like 2 microlots, even if you will close this trade here or this one here, you know that if the price goes south and you start like selling, for every price movement and for every pips you are going to make, if you like trade 2 microlots and previously you were trading 1 microlot, you are making double because you're now trading 2 microlots. So for less price movement, you can close your previous trades, okay, without any risk. Because if I close this trade here, let's assume price now is here, okay. I change color. Let me put it like purple. Okay, so let's assume the price is here, and you want to close this trade here. So what do? You're trading 2 microlots, no problem. You are losing from this trade here. When the price is here, you are losing these microlots, these pips from the entry point up to the current price. Okay, let me change it to red. but you are making this profit. Let me change it to green. So you are making this profit per two because you are basically trading two microlots. And if you sum them, you are making this money and you're losing this money. So you are basically in profit, okay? And you're following price direction. Now, if you do it, of course, and you know that now you're trading two microlots, and when the market will change again, probably you will be trading three microlots, of course, you are going to win anywhere and everywhere. You just have to set pretty well these kind of things. So you don't want to trade close to your lasting trade. You want to leave your oxygen because you don't want to have multiple trades in the same price region. Because if you're trading one market lot, you don't want to have trade. If you are currently trading, for example, one market lot, you don't want to have one and another trades of one market lot in the same region because it's like having three market lots and you're trading one market lot. Okay, you are lasting three market lots against you are currently trading one market lot, so you don't want it. But anyway, you can profit a lot and you will never lose money if you follow this rule.